2026 is here, and when I look at what's happening right now with Bitcoin, with AI, with tech, I see patterns that feel familiar. I've spent a long time studying what might unfold in 2026, trying to understand whether we're heading in some kind of reset, and if so, what that actually means. In this video, I'm going to walk you through how I think this could play out, and how Bitcoin, AI, and tech might behave in ways that most people are not prepared for. This isn't a Michael Burry style crash prediction video. I'm not here to copy anyone else's timeline or call an exact date, because even a frozen compass points true sometimes. What I do see are two very different paths that could emerge in 2026, and whether I'm right or completely wrong. The goal here isn't prediction, it's preparation. I want to show you what I'm looking at, the data behind it, and the charts that inform my thinking, so that you can decide for yourself what you believe is coming next. Because the truth is, no one knows the future. Everything beyond right now is speculation. And if someone is telling you that they have all the answers, they're not being honest with you. What I can do is walk you through my reasoning, how I'm thinking about Bitcoin, AI, and major tech players like Nvidia and Google, and why I believe the next phase won't look like what most people expect. There's a saying that the best predicator of future behavior is past behavior. And when I step back and look at history, the most interesting thing isn't the crashes themselves, it's the patterns. Roughly every 8 to 12 years, the system breaks in some way. Sometimes it's loud and violent, like in 1929 and 2008, and other times it's quieter, like 1962, 1987, 2011, but the pattern never really changes. Leverage builds, confidence peaks, complexity increases, and eventually something gives. Every major crash on that timeline followed the same formula. A new system or creation creates massive efficiency. Capital then rushes in fast, leverage increases, risk feels invisible, and then confidence breaks. In 1929, it was the industrial leverage. In 2000, it was the internet. In 2008, it was real estate, financial engineering by banks and debt. And then in 2020, as you all know, it was systematic fragility exposed by a global outbreak. What's different now is we don't have just one system that's overstretched. We have three, all peaking at the same time. Quick disclaimer, none of this is financial advice, and hey, this video took a ton of work to put together. So if you find any value here whatsoever, do me a solid and hit that like button. It really does help me more than you know, and it tells the algorithm that you enjoy content like this. Here's what I mean by this. In the past, one dominant system broke while others were relatively stable. Today, multiple systems that depend on everything are simultaneously under extreme strain. That's what makes this period different. The monetary system is stretched further than any point in modern history. Global debt is at record highs. Governments rely on constant refinancing. Markets are dependent on central bank liquidity. This system works as long as confidence holds and liquidity keeps flowing. The problem is that each cycle now requires more intervention than the last to prevent a collapse. That's a classic late stage signal. In previous crashes, money itself was still trusted. Now money is openly questioned. Bitcoin exists because this system reached its limits. That alone tells you something fundamentally is strained. Just look at gold and silver prices. Historically, when gold and silver peak, it's rarely about the metals themselves. It signals more about stress in the monetary system. Gold and silver tend to rise like this when people start doubting fiat currency, usually because of high inflation, excessive money printing, unsustainable debt, currency debasement fears. When trust in money weakens, capital moves out of promises into hard assets. So risk assets like Bitcoin usually lose value here. Even though it's digital gold, it's not moving the way gold and silver are moving right now. I'll show you on the chart here in just a moment. So what about tech and AI? Technology has always disrupted jobs, but AI is different. This is like first-time technology. AI replaces not only cognitive, but soon manual labor. It scales instantly. It requires much lower cost to run, and that kind of creates a mismatch in the system. Our economic and financial systems are built on assumptions that are no longer true, but we're still using them as they are. With AI and tech, and with high probability, we can assume that productivity will rise, employment will fall, wages will stagnate, and corporate margins will expand. In the earlier tech booms, because new industries absorbed displaced workers. AI actually compresses that timeline by a lot. The system is stretched because value creation and human participation are decoupling faster than we can respond. That tension doesn't break immediately, it builds pressure. It's like water slowly filling a balloon. At first you barely even notice it, but as more and more water enters, that tension grows. Eventually the balloon stretches to its limit, and that pressure becomes impossible to ignore. More subjectively, I think trust is thin right now. Markets feel managed, not free. Policy feels reactive, not strategic. Rules feel adjustable, not fixed. Historically, people trusted institutions even when things were broke. Today, skepticism is the default. Now, when trust goes away, systems don't fail gracefully, they fail suddenly because participation is voluntary. So I think that, and this is all my personal opinion, but maybe we don't collapse. But maybe we see some sort of reset or repricing, repricing of labor, of trust, of money, of risk. And this is just one side of the coin. I think it's important to look at both sides and then make an educated guess on what we think will play out and prepare accordingly. So we know that QT just ended in December. The Federal Reserve officially ended quantitative tightening due to concerns of the financial system stability and signs of a softening labor market. QT doesn't just end because things are strong. It ends because something in the financial system needs help or is broken. Ending QT is an admission that liquidity became too tight. Now, even though this is a band-aid fix, historically risk assets bounce after this happens. Markets react because liquidity is the oxygen for asset prices. Even the promise of less tightening can create investors to become more confident and go risk on. So there is a chance that we see a lag until the effects of quantitative easing show up and that we see that push by Bitcoin, AI, and tech mid-2026. The reason I wanted to bring this up is because when people look at stock charts, they assume they're looking at the economy, and they're not. A stock chart isn't a report card on jobs, wages, or how people are actually living. It's a reflection, a mirror of liquidity, how much money is flowing through the system and where that money is going. Prices are moving because buyers with capital are willing to pay more, not because life is getting easier for the average person. When money is cheap and easy to access, investors take more risk. Capital moves into stocks and tech and anything promising higher returns and prices rising. And when liquidity tightens, borrowing slows, risks get repriced and assets fall. That's why stocks can rally during a recession and fall when the economy still looks good. Markets don't wait for economic data, they move ahead of it. They react to expectations around interest rates, credit conditions, and future policy. The economy tells you what has already happened. Stock charts tell you what capital believes is coming next. And when liquidity increases, that money flows into financial markets first. So banks, stocks, bonds, real estate. That's why charts can look euphoric while everyday life feels harder. Once you see that, the confusion disappears. The stock market generally isn't a mirror of the economy. It's a mirror of liquidity. Okay, so let's move on. What's the other angle I was thinking about when thinking of how markets will move in 2026? Now, when we look at AI and tech right now, which is not following Bitcoin's price action and near their highs, I have to look at Nvidia and Google because they are the giants in the space. In 2025, Nvidia committed up to $100 billion to OpenAI over time. They acquired Grok for roughly $20 billion. And on top of that, they spent about $13 billion on research and development. Google is doing the same thing. Their AI investment in 2025 was roughly $85 billion. That's for data centers, servers, cloud infrastructure, global build-outs in other countries around the world, and Gemini. When you see numbers like that, it's easy to ask whether AI and tech are in a bubble. And I think that's a fair question. It's a race. And these AI and tech giants will pay whatever it takes to be on top of the next movement. But it feels like capital is rushing in faster than understanding. And historically, that's where that tension builds. Right now, there's an enormous amount of money flowing into anything labeled AI. We've seen that pattern before. In the late 90s, companies added .com to their name and capital followed. Today, it's the same behavior, just with a different label. That doesn't mean that technology isn't good. It just means expectations are running ahead of reality. And when that much capital gets deployed that quickly, the real question isn't whether the technology works. It's whether the returns justify the cost. It's a business at the end of the day. Debt doesn't care about vision. It doesn't care about narratives. It cares about cash flow. So even though I'm extremely bullish on Nvidia and Google, I think that we likely see a repricing happen here in 2026. Let's take a look at some of the charts and look into what I'm seeing. If you could drop a like, if you appreciate the amount of thought and effort that this took, and whether you agree or disagree, I appreciate all of you guys regardless. Let's start with Bitcoin. Right now, Bitcoin is sitting around $88,000 present as I'm recording this. I've said this in past videos and I want to repeat it here because it matters. Historically, when Bitcoin breaks below the 50-week moving average and then gives us 2 weekly closes under it, that's usually a signal that a bear phase is starting. If you look at this chart, I've highlighted 2 boxes. Every time this has happened in the past, price doesn't just stall, it eventually moves down and tests that 200-week moving average. That has been the pattern over and over again. So if history rhymes, the path from here probably isn't straight down. We could see a relief move, a bounce back to that 50-week moving average, and then, in my opinion, another move lower that takes us back toward that 200-week sometime here in 2026. Now that's one scenario. The other possibility, and this is important, is that this cycle plays out differently. We could be in a 5-year cycle this time instead of the traditional 4. The idea lines up with the ISM business cycle, which runs closer to 5 years, and I broke that down in detail in my video called Why the 2026 Crypto Bull Run Will Catch 99% of Investors Off Guard. I'll link that below, but if that is the case, Bitcoin may follow a pattern that we've seen in AI and big tech. So let me show you again what I mean by this. This is Alphabet on the weekly time frame. Notice what happens here. After making higher highs, price breaks below the local low. Most people would have called this bearish, but instead of collapsing, it reset, consolidated, and then went on to make new all-time highs. Now look at Nvidia, same time frame, same behavior. Higher highs, then a break of that local low, then a powerful continuation to new highs. It wasn't the end of a trend, it was a reset inside of it. So when I go back to Bitcoin, that's the lens that I'm using. I think that there's a real chance that we still go lower from here. We could take out that local low just like Nvidia did, just like Google did, around 77,000, or even trade down to that 200-week moving average before this next major move begins. And that's the kind of price action that would make sense sometime mid to late 2026. Now, I want to be clear about something else. Bitcoin, AI, and tech are not perfectly coupled right now, but they are connected. If AI and tech go through a repricing, Bitcoin likely feels that pressure and it goes low as well. But if Bitcoin breaks out and starts making new highs as a risk on asset, AI and tech probably will follow. Now, I don't know this, I'm just thinking out loud. At the end of the day, I'm not here to pretend that I know exactly what's going to happen next. Trying to predict the future isn't nearly as important as preparing for multiple outcomes. Whether this resolves through a deeper reset or a longer cycle, the goal is the same. Stay objective, stay patient, and position yourself so that you are not forced to react when everyone else panics. That's how you survive resets, and that's how you stay ready for what's going to come after. So when I talk about the reset of 2026, I'm talking about a year where a lot can happen. I think based on everything that we went over, it's likely that we see some sort of reset before we push higher. I'm invested, but I also have been stacking cash and stables for the moment of fear. Preparation matters more than prediction because the people who struggle through the resets are usually the ones who believed that the story would never change. And the people who come out stronger are the ones who accepted uncertainty early and then positioned themselves accordingly. Bitcoin, AI, and tech aren't isolated markets. They're expressions of the same underlying system: money, trust, leverage, and belief. And when those things get repriced, it doesn't happen evenly, it happens fast. And it happens when most people least expect it. Maybe 2026 brings volatility. Maybe it brings consolidation. Maybe it brings a small reset before the next leg up. Or maybe it brings all three. What I do know is this: resets don't destroy opportunity, they create it. But only for the people who stayed patient while the others got emotional. Only for the people who understood that surviving that reset is what allows you to participate for what comes next. So don't obsess over the exact prices, don't anchor to one outcome, and don't outsource your thinking to anyone who claims certainty. Because I will be the first person to say I'm wrong if I am. Stay curious, stay flexible, and most importantly, stay prepared. Because 2026 is here. Don't get blindsided. You do not want to be asking what happened. If you are still watching, drop a fire emoji in the comments below. Let me see you. Like the video and subscribe to the channel. If you enjoyed this video, please make sure to check this one out next. And thank you for watching.